G'day guys, welcome back to Mango Invest. In this video, we're going to continue our dividend stock analysis videos. A few people have enjoyed these videos, so I want to keep working on these. But we've just looked on macro trends, and we're looking at the top 100 high dividend stocks within macrotrends.com. And the first one that they've got here is MPLX LP, which is an oil and gas company. And the way they rate the top 100 dividend stocks is the amount of dividend yield, which doesn't necessarily mean that is a good dividend stock. They could be putting their high dividend yield up there just to cover up for some sort of fault within the company, to make it a little bit more attractive to investors there. But before we get into the financials, we'll see overall what the company's all about. So you can see here, they work with crude oil, renewable fuels, chemicals, and feedstocks, fracking, transportation of all this stuff, exchange and storage and of natural gas liquids and all that type of stuff there. So fairly complex, if you ask me. I don't really know too much about this sector, but that's MPLX in a nutshell. Funnily enough, if you actually type in MPLX on your stock exchange, it won't actually come up. The parent company is MPC, who own MPLX, just for your awareness there. But we'll have a look into the the financials just to see how they're going there. Looking into the income statement straight away. Let's have a look at the revenues. Most recent one is like over $11 billion in 2022. And as you can see there, from 2013 all the way up to 2022, it looks like a nice linear progression. They're not really going backwards, as opposed to 2020, which we can all understand, with the pandemic and all that sort of stuff. But the cost of goods sold, that is obviously going up with their revenue, but coming down to the gross profit, you can see that nice linear progression of the gross profit. As I said there, they're not really going negative as opposed to 2020, which is understandable there. So nothing overall concerning there. Let's have a look at the shares outstanding, and then that's steadily sort of increasing. It's tapered off of the last sort of 2 years, but what the shares outstanding are telling you there is that the company are issuing more shares into the company within the stock market, which essentially decreases your shares in value, which not isn't necessarily a bad thing. Like, if you're there just for the dividend yield, it's decreasing the shares, so therefore you can buy more at a cheaper price. If you were to own this company purely because of the equity, that would then make it decrease in value, so you might not really enjoy it there. But overall, for me, that's not really a factor. Let's have a look at the balance sheet. Let's have a look at the total assets versus the liabilities. So in the last sort of 2022 report there, total assets being 35 billion and the liabilities are 23. So at least the assets outweigh the liabilities, which is good. We'll just see how it's looking over the history there. From 2017 to 2018, like a massive spike for a couple of years. It's slowly starting to decline and then taper off. That's not really concerning to me. That's fine there. Let's have a look at the liabilities. And that's pretty much mirror imaging the total assets. As they buy more assets, their liabilities are going to obviously, increase, which could potentially increase their cash flows for their investments as well. Let's have a look at the cash flow statement and the cash flow from operating activities, and that's looking very good. Just an increase of steady cash flow from 2013, to 2022. They are a fairly new company. I believe these guys opened up, in 2013. So, just over, 10 sort of years they've been operating. So that's good to see that their cash flow is steadily increasing. Let's have a look at Seeking Alpha and head over to the dividend tab. But you can see the dividend summary that a starting dividend yield at 8.87%, and the 5-year growth rate is just under 5%, which it's not too bad. That's fairly standard. For like some of the really good companies, or the ETFs like SCHD, their sort of 5-year growth rate is like 15%. There's another one like Snap-on Tools, like a random tool company. Their 5-year growth rate is like 16 to 17% or something like that. So it's ridiculously high. But just because it's 4.90%, that doesn't imply that it's overly bad. It's just not as high as some of the good, consistent companies. The dividend growth rate, sitting at, the dividends growth, which has consistently grown every single year for 9 years currently. So that's pretty good. That's showing some form of consistency there. Dividend growth tab, this is what we want to have a look at, because this actually tells us how much the dividends have been increasing per year. So looking at 2013, this was the starting year, so they didn't actually have a dividend increase. They just had a starting dividend yield of 4.93%. And then they increased it the next year by 29%, next year 27%, and had a good level of steady increases up until 2021. And now looking at 2022, you've actually had a decrease by 13.54%, which is, and this is the concerning sort of factor that I had with this one, because remember, a couple of minutes ago, we were just looking at the profits and we had a steady, flow of, revenue and the cash flow within their business was looking fairly linear, like fairly progressive there. But for some reason, they've had a decrease in the dividend by 13.54%. So I'm not too sure why that is. If you do have more information on this, please give me a comment below, just to, let's try and find out what this decrease is all about, because that doesn't really make any sense if their financials are looking fairly good. We'll just have to find that one out there. So overall, would I sort of invest into MPLX? Probably not. Like, from what I'm looking at here, the financials look, fairly good, and they've got a really good starting dividend yield of over 8%, with a 5-year growth rate of, just under 5%, and that's really good. But, I just don't know what that negative 13% of the last year is. Until I find that out, I won't really, look further into this company, because there are sort of, better companies for the money that I have. So such as like SCHD and Realty Income Corporation, they've got lower starting dividend yields, but the growth rate is an extra 10% every single year. Plus they've been growing their dividend. Like Realty Income Corporation, for example, have been growing their dividend for, 25 years consecutively. So, if you were to compare the two and where you'd put your money into, I think, companies like Realty Income Corporation would be better value for your time and your money. But that's all I've got for this video. If you did like it, give me a like, and please subscribe to the channel. It really helps out, and I'll catch us next time.